on one of the very last Fridays we have left in the summer, which means football season is coming really quickly, and school is about to start really quickly. Today was a move of what was up is down, what was down is up. I'm going to explain what I mean by that with what's driving the price action, not just today, but these last couple of days. What's driving us upwards? What's really outperforming? Why? I'm going to break all that down, and we're going to find an area that's starting to lag. There was a position of strength in the past. It's starting to lag, and we're going to talk about how to trade that. So let's go ahead and get started. Today is Friday, August the 17th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking and mousing over the Market Scholars logo right here in the bottom right corner of your video. Then click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That lets me know two things. You like the video tonight, you want me to keep doing it. Me and Brandon to keep doing these videos day after day. Really easy, one-click way to give us feedback on what you're thinking there. Also, comment on anything that stands out to you. You have to scroll down further, but we want to hear what you're getting out of the video. What questions or comments do you have about what we talk about? Join our daily Market Outlook email list. Really easy way to do that. Click the icon that's popping out in the top right corner of your screen there. That will subscribe you to our list. Also, follow me on Twitter for more content that's like this throughout the day. And then join our Market Outlook community on Facebook. All right, well, let's take a look at the S&P 500 and see what's going on here today with the market forecast indicator down there at the bottom. You see that we maintain a strong bullish posture. So we had a weak bearish posture for all of one day. And not only did we turn back green, but we went back to dark green, which means we turned back up above 80 just like that. Again, just a reminder of how weakly bearish a posture is when we turn light pink. So this intermediate run, which started back here, coming up off that intermediate low point, crossed above 50 right, let's see, what was it, the 9th? Yep, so July 9th. We are now over a month, heading into about a month and a half of a bullish run. Now, keep in mind, before that level, we kind of closed above all these high points at 27.59. So the first day that we turned bullish, coming up off that low point from 27.59, we're up almost 100 points, and of course, the low point here at 26.91, we're getting close to about 150 points to the upside, a little bit more than 150 points. So it's continuing to run, and and a lot of people thought, we were ending here, and there were some signs of weakness here, but the trend is still there. The market sentiment line's falling, but keep in mind it's also at very high levels. So, as weakly bearish as this intermediate run, this bearish intermediate posture was when we're light pink, that's how weakly bearish we are at market sentiment, right? It's falling, but it's also at very, very high levels. So it can turn up and be strongly bullish again, just like that. Now, not in the day, not like the intermediate line, it's a bit longer term line, but it can get up there really quickly. You see the near term line has also got back up above 80. Now it's kind of dipping its toe up there, just like this high point here. And we haven't got up to a new near-term high point yet. We're still below the previous one, which lines up with that peak. So it's not like we're back, full bore bullish again, but we're looking a lot better than we were just a couple of days ago when we were breaking down below these low points and had those 4 consecutive bullish intermediate confirmation signals, which previously, last time we saw that, preempted a big drop. Now, granted, it was coming at the very tail end of a long, way longer than normal intermediate run. So we weren't overextended at all in this intermediate run. In fact, when we talked about that cluster back in mid-July, we talked about that cluster coming soon after a new bullish run starting, kind of solidifying the potential for a kind of 2 to 3 month run. So, we'll see if that ends up being the case as we're heading towards that second month, right? Beginning of September would be that second month. There is seasonality towards the end of August. We need to be aware of that bearish seasonality But if you take away seasonality and you look just simply at the chart and don't worry about the dates on the chart, you would expect some more bullishness, and you'd expect a new near-term high to come out of this, which would be a new all-time high. Because again, the all-time closing high is at 28.72. We closed at the high of the day before the 4 consecutive bullish intermediate confirmation signals with the Harami there, and then of course the breakdown. So we still got about 22 points to get, and the high point here at 28.62 was about 10 points away to get up to that all-time high on the S&P. So that's what we're looking at. So the trend going into next week continues to be bullish on the S&P. Now we're a lot further away from that on the Dow. So just a reminder of how much more of a run we could get without being overextended, right? But the pattern, the market forecast looks almost exactly the same as the S&P 500. The NASDAQ still is bearish, so it's light pink, so it's not like this run, the intermediate run hasn't ended yet on the NASDAQ. And we are getting a lower high point on the intermediate line, but again, the posture, we got a green line here. We're back up above a rising moving average. That's the near-term line's back up above 50 after being down below 50 for a while, kind of coming up off of Fibonacci support on a near-term basis. And then the Russell 2000, which has been really tightening up. I've showed this before. I'll show it one more time for you. The Russell 2000, actually IWM, it had this big significant area of volume here, and then we broke out of that significant area of volume. And if I go back even more than just the 1 year, let's go back 2 years, you can kind of see again big significant area of volume that we broke out of right here. When we broke out of that, there was no volume up here, right? Because there had been that was all-time highs. So there's no volume, and so that happens when you break out of a big sideways action, just like you did here. You had a big sideways action, you broke out, then you consolidated again, and then you broke out, and we consolidated again. And again, when you break out, so again with the breakout, when you consolidate after a major breakout, you expect to break out of that consolidation in the same direction that you had going into it. And so again, no volume up here because it would be all-time highs. That's the expectation for the Russell 2000. So let's go back to the market forecast chart here. So you can see back to the Russell 2000, it hasn't been as bullish. It's still actually weakly bearish, but you notice it hasn't crossed back below 50. So we're just kind of sideways action with, again, the expectation that we'd come out of that sideways action to the upside, simply based on the price pattern, nothing more, simply based on the fact that this is a symmetrical triangle coming off of a breakout move through a major resistance level. So typical consolidation after a major breakout move. Alright, quick reminder that you can watch our market outlook videos here on marketscholars.com if you're not already doing that, where you can see our upcoming schedule for classes. You can subscribe to our website by clicking this icon up here in the top right corner. Of course, you can come down and like our tweets. In fact, that's how we know that you want us to keep doing these videos, is by 3 clicks actually. 1 click here, click on the like for tonight's market outlook tweet. Just click that button, opens up a new window where you can click on like and let us know there. The second click is clicking on the Facebook post here. It takes you to your Facebook page, and on your Facebook page you can like it there by clicking on this like icon. And then finally the third one is to click it there. We also ask that you share. If you feel like this is valuable, you think other people should check it out, click on either one of these and share it with people in your own social networks. Again, our goal is to get that up to 100. I think 50 is our highest number that we've gotten to, and we're getting close to getting above 50, but let's see if we can't get that up 100 again. If you feel like this is valuable, that other people should check it out, then go ahead and click on either one of those buttons there, or one or more of those buttons there. All right. When you take a look at the long-term chart, we had that little bit of a long upper shadow last week, but we're still up above. So we did end up getting into a new higher close this week, closing not only above last week's close, but closing above the week before that's close. So we're continuing to push slowly higher above a rising 50-day moving, above a rising 50-day moving average, above a rising 200-day moving average. The 50 is moving away from the 200-day moving average. That's what this line tells us. So again, you can't really be more bullish, except for one thing. I've shown you this before. The Hakenyashi candles. You can see we got a lower shadow. When you get a lower shadow, that can be indicative of a trend reversal. Keep in mind that the midpoint of this body will be the open for next week. So the midpoint, and if you look at SPY, so we can look at the chart here later, but the midpoint of this body, remember the open and the close is different than normal. The close is the same, but the open's not the same. The open is always the midpoint of the prior week's candle. So if you look at this week, 282 is the open over there on the top left. 283.5 is the close. So we got about a point here. Let's get this. Oops, over here. So 283.56 minus 283.56 minus the open of 282.23. We'll divide that by 2 and add that to 282.23. So that puts our midpoint at 282.89. That's where next week's open will be on the candle. That doesn't mean that, well, the price will actually be there, but that's where the Hakenyashi's open candle will be. And right now we are trading at 285.06. You can see up here in the top left. You see how the close here was at 283.56, which again, sorry, is not the closing price, obviously, but it's the average of the open, high, low, and close for this week. So, that was the average, 283.56, and we are trading now at 285 with the midpoint being at 282. So to put the context there of where 282.89 is on the intraday chart, 282.89 is right in this area. So if we fall back down below that area here, right where my cursor is, then we'll get a long lower shadow again next week. So we are trading a lot closer, obviously, to the high of the 4-week high point. We could not say that earlier, and that's the reason why we got the lower shadow in the Hakenyashi this week, because that breakdown. But you see how that breakdown into the lower half of the 4-week range did not hold. This 4-week range will pretty much stay intact. You got that low point right there that will stay there for a while, so it will stay intact there. I wouldn't expect that the midpoint will move up very much. So we'll stay in the top half here. As long as we stay in this area, then we will avoid that long lower shadow and we'll stay up into that top. So we'll keep our eyes out on that for next week. That's a little sign of weakness, right? That lower shadow on the Hakenyashi, on the it's just a little sign. It's not completely we're bearish now because everything else here on this chart is bullish. But one small sign, that little lower shadow, is a small sign that we might consolidate a little bit here. Take a look at the 3 green arrow charts, and you'll notice we're back to 2 of the 3. So the moving average has stayed green this whole time. That's why we never did get pink shading here. The stochastics turned up from a phantom green arrow, so bullish low point. The bulls we never did start to close. In the last 14 days, what the stochastic shows is where we're closing. In this case, it's an average of the last 5 days. So if you look at the average closes over the past 5 days, where is that average in relation to the 14-day high and low? And we're still in the upper half. So yeah, we had a little bit of a downward move, but average it all out, and we're still closing in the upper half of the range and turning back up. So that average price is turning back up again. Phantom green arrow, very bullish sign, just like this one was over here. If you look at the the two-line versions, you can see both the MACD and the stochastics is turning up, almost getting above their moving average, or their moving averages, which would be more bullish. But you can see back up above the 8-day moving average yesterday, staying above it today. All three lines rising. So again, still maintaining bullishness. Small sign of weakness on that long-term chart, but still across all these charts, still maintaining a bullish posture. So higher high, we did test yesterday's low point, which was the gap that we opened up, where we opened up on yesterday. So we tested that low point, got up to a new higher high at the end of the day, pulled back a little bit into the close to test that high. You can see there's some resistance in this area that we'll have to muddle our way through. If you take a look, you can see the volume is slightly above average. Today's trading range over here, this R number right there, the trading range is a little bit above average, or almost average, excuse me, 2.19. You put those numbers in context. 65 million shares trading is, like I said, a little bit above average, but still very low in the 52-week range. 2.19 is a little bit below average, also towards the lower end easily of the 52-week range, and the relative ATR still below 1%. So still maintaining bullishness there. And then finally, volatility continues to fall. It had a jump. When it has these jumps, we fall down rather quickly, and we're already back from 16 all the way back down to 12. So that's how fast these things can last. And you look at, on a relative basis, which is a lot more important, back into the bullish zone. So we got into the neutral area for a day, but just like that, right back down into the bullish zone, trading right around the sweet spot of that bullish zone. So to summarize, the market posture remains strongly bullish. The S&P, or excuse me, the Russell 2000 and NASDAQ Composite are lagging, but the large cap index is still pushing higher. We'll talk about what's driving a lot of that here when we get into sector rotation and how the different asset classes are performing. But the posture remains bullish, and we continue despite expectations for some weakness and seasonality due to seasonality by the end of the month. So we'll keep our eyes on that. But absent that, the charts still show that we expect upward movement, especially with an extended consolidation in that small cap index and expected breakout to come out of that to the upside. So what do you think about that posture? Do you agree with it? Do you disagree with it? I want to hear from you. And the easy way to do that is click that little icon popping out in the top right corner of your video. It will open up a window there with a poll that you click on, either agree or disagree. If you disagree, scroll down to the bottom into the comment section. Let me know what you think. Let me know what you're seeing that would suggest maybe that we're too bullish, or that we should be more bearish, or excuse me, that we're not bullish enough, or that we should be more bearish than we are, with some things that you're looking at, and share what you're seeing down there in the comment section. Remember, you can also comment on the blog for those watching there. You can also comment on or reply to tweets and Facebook posts, depending upon the social network that you're linked to. All right, what's driving this rebound the last couple of days? You can see it here on these charts. The dollar dropping the last couple of days from very high levels. That's producing kind of a morning star candlestick pattern there on gold, coming off some oversold clusters. Commodity prices starting to rally up a little bit. Crude oil not really benefiting as much. Bond prices rallying, and you can see all stocks, real estate stocks breaking up to new 3-month highs, dividend stocks breaking up to new 3-month highs, preferred stocks rallying, and MLPs bouncing off a higher low as well and getting closer to 3-month highs. So equities different. I mean, all across the board equities. You can see over here on the left, emerging markets bouncing up. They've been the most oversold. So they're benefiting the most from what the dollar's doing. There's your developed markets coming in about half their gains. Gold also very oversold, so bouncing up as well. And there's your MLPs, your real estate stocks, your very oversold agricultural. So basically kind of a bounce of what was oversold and a pullback. Really the only asset class that fell today among this list was the dollar. So a pullback because it was so overbought. Everything else pretty flat. You can see short-term bonds. Bonds all across the board rallied. There is TLT up almost 0.25%, and high yield, You can see investment grades there. There's your short-term bonds, relatively short-term bonds. So all of them up a smidgen. But small cap stocks outpacing, at least for today, outpacing the S&P. Mid cap stocks outpacing that. Value stocks picking up and outpacing growth. So it was this last couple of days basically has been let's buy what's been beaten up and start looking for reversal with some pretty important meetings supposedly coming into next week with the Chinese trade delegation coming to the United States for trade talks. After a couple of busy days on the economic calendar, we kind of had a lighter day today with consumer sentiment coming in and pulling back, but remaining at relatively high levels. So you always have to, I know a lot gets put in, consumer sentiment went down and oh no, and the reality is it's still very high relative to where we've been on this trend that we've been going on. From an economic surprise standpoint, we're just not, we're not beating estimates anymore. In fact, we're kind of coming in below estimates more often than not, according to the Economic Surprise Index. Whereas with the G10 economies as a whole, economic indicators kind of matching, a little bit underneath, but pretty much matching these estimates. So we're not really getting a push one way or the other. I mean, the economic indicators not falling significantly, otherwise we'd be down here. But they're not rising significantly either, and so we're kind of in this midpoint. And economic, at least the interest rate hike expectations. You've got we're obviously almost priced in for a rate hike in September. The odds of December, of that next rate hike being in December, remain above 60%, though that's a little bit of a pullback. Here is the odds for December coming up. This is kind of reflecting that where it was, so it hasn't pulled back down to 63% yet. But you can see how we were. In fact, you can see it better here. Oops, not there. Let's get back to this chart and just look at the current. And you can see, as of a day ago, we were at close to 70%. So that historical chart, hasn't reflecting that pullback quite yet. Even though GDP estimates remain strong, 4% for Q3, coming off a strong Q2. So we're and Q1 was weaker, but it was a relatively strong Q1 compared to previous Q1. So economic growth is still there, and the U.S., as we've seen before, continues to kind of be a model of outperformance, of relative strength. If you take a look at the foreign markets, we've looked at this before, and take a look at this chart right here. So today, pulling back, not as strong of a day. Again, this areas have been oversold the most, bouncing up, all except for Brazil at least. India, Canada doing really well. China and Russia, so emerging markets really doing well, and there's Korea kind of matching what China's doing. France, Germany, and UK lagging what's going on in the emerging markets, but outpacing the U.S. stock market, and all of them, you can see all of them just bouncing off of very oversold levels, except for India, which happens to be bouncing off a nice higher low point. So a good move there for India. Russia kind of an engulfing pattern developing. Canada bouncing off the low end of this 3-month range. Expectations are moving back up to the top end of that range. And the dollar still the only one that's got the strong bullish posture. The only other ones with bullish postures are Korea, which is just as weakly bullish as you can get, 0.02 of a point above 20, and Canada, which is flat. Its intermediate line has been kind of in that midpoint as their stocks trade pretty sideways. Some chatter about what's going on with yields. In fact, let's take a quick look at the long-term chart for yields here. Long-term bonds. We'll do the 10-year yield. You can see, we've had a couple down weeks here, and we're pulling off of this 3% level. And if you look at a daily chart, a little bit of a head and shoulders pattern developing here. Triple top with the top in the middle being a little bit higher. So go back out to the weekly. So, your neckline would be kind of drawing up this line. There's potential with falling momentum. And you had this divergence here with the head and the shoulder. The head and the first shoulder Head and shoulders patterns typically have divergences there. Here's a divergence on this one, a little bit wider of a divergence with higher highs that led to that weakness. So you can kind of see how the equity markets are anticipating some weakness in the U.S. sectors right there. Are anticipating that weakness. Look at real estate taking off. New 3-month highs for real estate. New 3-month highs for staples. Remember those dividend stocks is doing as well. New 3-month highs for utilities. Healthcare, new 3-month highs. Those are all your typical safe haven areas. And for real estate and utilities, interest rate sensitive areas. So they tend to do well. And of course, telecom as well, kind of lumped in there as also an interest rate sensitive area. You see how they're anticipating a drop in yields with bond prices rolling back up again. So that's an interesting development. You know, utilities and materials are bouncing up. They have been so oversold. So continuing that theme of, you know, asset classes are bouncing that have been the most oversold. And of course, technology starting to go sideways, coiling a little bit. Higher lows, lower highs, so starting to coil, and financials also stuck in a sideways range. And again, if these continue higher and interest rates do roll over, you would expect weakness, relative weakness, in XLF compared to like utilities. In fact, if you take a look here, let's take a quick look at XLF relative to XLU. So it's one interest rate sensitive area relative to another. You can see how financials are lagging utilities and rolling over after with the 50-day moving average of that relative strength line crossing of the ratio crossing below the 200-day. So there's some potential weakness in this area that you would expect. You would expect yields. Yields have been rising during this time. That might be one area, one reason why the market looks like it's anticipating some weakness in yields going forward, even with interest rate hike expectations still being pretty strong, pulling back today, and even with the economic growth expectations maintaining their strength. Now, on the blog, we released our new sector selector. So if you go to marketscholars.com, Brandon's updated the sector selector tool that he's created, proprietary to Market Scholars. It's a great tool. There's more to it than this that you can get for our premium subscribers. But you can kind of see here, just looking at the half of that tool, that utilities has been, they were relatively weak. Remember when utilities and real estate were getting hammered, and then boom, they took off, and they've been up here to the top for a while now. Healthcare maintaining its relative strength too, pulling back a little bit, but maintaining its relative strength. Staples is right up there too at this 5th level. It's been kind of lagging behind these other safe haven areas, and you can see consumer discretionary bouncing back up. It had been a strong area. Weakness during the recent weakness here, pulling back, but now bouncing back up pretty strongly, with areas like material and energy struggling, and that strong dollar related right there. Financials struggling this whole time, again related to that weakness, or at least expected weakness in yields. You can see technology pulling back too. So there's some relative weakness. You can see the market is focused right now on safe haven and interest rate sensitive areas as of right now, and you expect as the markets get strongly bullish going forward, some movement in some of these areas to the upside, especially technology. But as of right now, we're not getting that. See, the direction of technology is not, it's not like it's coming up from low levels to get the 7th. It's coming down from relatively strong levels just as a month ago and pulling back towards the bottom. All right, one stock in that technology area that shows 3 red arrows today, and not 3 red arrows coming down from on a bullish trend that you'd expect a bounce off of. I mean, this is 3 red arrows coming down from the top end of a relatively sideways trend, potentially moving to the downside. That's on NVIDIA, obviously a very popular stock. Breaking down below today, a lot of low points here, coming off of earnings release. You can see here the earnings. If I click on, there we go. the earnings release here after the market yesterday. The market pulling back, shading pink because we have all three red arrows there. If you look at the market forecast indicator for NVIDIA, you can see, turning pink there as well with a falling market sentiment line, and of course, remember how I mentioned the relatively sideways trend. If you look at the long-term view, you see how we've had divergences galore. Like the peaks have been steadily getting progressively lower, and this one was really low, even though the peaks on the index, the stock itself, has been getting progressively higher, breaking down below the 50-day moving average today. Look at the Bollinger Bands for NVIDIA. You see that we are pretty much at the lower band. After pushing the upper band up, we went through the middle band and broke down below some important volume areas in this. And of course, not much volume here until we get to this area, down to the 225-ish area. So not a good sign with rising bands. And you can see again on the DMI indicator, you can see that it's negative DMI crossed up above 25, and it hadn't done that here. I mean, briefly right there, but it hadn't done that since that low point. So here's the last peak on the DMI, and at least the last bullish peaks that we had are right here, higher highs, but then the lower highs, and then you can see we barely got above 25 on this peak on the positive DMI before pulling back, and now the negative crossing up. So it's trending down according to the DMI with a lot of volume, not just on the earnings, but even before that. So some bearishness setting up for NVIDIA. Gives us an opportunity to sell options here. You can take a look at the, let's see, where we're looking at the September, the September 21 options. You look at the 255, which is in that 30 delta range. Relatively wide spreads. Remember, it's an expensive stock, and if the spreads were 43 cents or more, like 45 cents, then we'd be worried about how wide they are. But it's only 15, so not as bad as it could be. And this one's only 15 too. So you can see selling the 255, buying the 260, figuring out what price you end up getting here. I mean, ideally you want to get as close to 134 as possible. So you kind of depends on where you can get filled in. As long as you get above $1.16, that's the credit you're shooting for. And if you take a look at this on the Analyze tab, you got pretty decent odds of success here, close to an 80% odds of success. And then you throw that line, the break even, up on the chart, and what that tells us is, as long as we hold this gap down, if we rally back up above today's open, through the gap, and then back above Thursday's close, so so fill in the gap and then more, then that's when we'll take, we're trying to make $133 per spread. That's when we'll take a loss up here, about $133 per spread to the upside, so about that 258 level ish. So that puts you right into that area. So it'd have to get back up above the close for us to get to that level. So we kind of have an idea. I mean, it'd have to reverse this breakdown that we've had on earnings. And it could very well do that, but we see weakness in the technology sector. So you kind of have the sector working against this individual stock as we head into 35 days from now, the expiration for these options. So that wraps us up for today. Now I want to hear from you. Click on this link popping up in the top right corner of your screen. That will take you to our Market Scholars forums, to the Market Outlook forum in particular. Let me know what you think about tonight's market posture. Let me know what you think about the trade idea, and any questions or comments that you have on what we talked about in tonight's video. Remember, you have to subscribe first, but you can do that for free to our site. You can do that for free to be able to participate in our forums. As always, thank you very much for watching this weekend. Have a great weekend. We'll see you on Monday again. Remember to subscribe to our YouTube channel, like our video by clicking that thumbs up icon, and comment on anything that stands out to you from today's video. Follow me on Twitter for more content like this throughout the day, and join our Market Outlook community on Facebook. Thanks again, everyone. Have a great weekend, and we'll see you next time.